Hello again from me, Kevin French at Core Wealth. We are going to be covering the month of November, quite an exciting month in terms of global markets. And this is our last recording for the 2023, the calendar year, but we will still do a summary of the whole year early in January. November was a real bumper of a month. We saw global equity markets up over 9%. This was on the back of news coming out of the US. You'd have heard us talk about inflation and the Federal Reserve's response to try and control that by raising interest rates. Now, the news that came out was exactly the opposite. The inflation has come down now to 3.2% from 9.2% back in 2022. And on the back of that, they are now less hawkish about whether they would have to hold interest rates at these high levels for as long as previously suspected. That gave impetus to the equity markets and as well to the global bond markets in the developed world space. On the emerging market side, those markets were also up very strongly, over 8% for the month, but China is still struggling to really get its economy going. Some of the overhang from the property debacle that happened a couple of years ago is still weighing on that economy, and so the equity markets in China were only up 0.5% in the month of November, while everything else was up around 8% plus. On the South African front, our equity market responded in sync with the global markets, up really strongly for the month. Our bond market was also up strongly, as mentioned, and that was because our inflation, even though the headline number was not perhaps as low as some people had predicted, our core inflation number is well within the range that the Reserve Bank has targeted. And so these are seen again as good signs that we could see interest rates in South Africa coming down in early next year, and hence the strong returns in our local markets. So if we have a look at how specific markets and sections of the markets globally have performed, these returns are all in US dollars. We can see how strong the month was. And you can see there that developed markets as a whole up 9.4%, emerging markets up only 8% for the month. So really strong month. Global property indices up over 10%. The bond market up 5% for the month if we look at global bonds. And then you can see, interestingly, how the different regions had performed. That yes, the US market was up over 9%, but Japanese and European equities up over 11% for the month. So if we look at year to date and over the last year, actually the best places to have been would have been in European and Japanese equities, something that we've benefited from in our portfolios. Even the UK equity markets, which haven't done as well, are still almost at 9% over the last year. Emerging markets not having performed as well, and then globally, if we look at properties and bonds, especially over the medium term, 1 to sort of 3 to 5 years, we see there that those markets have struggled as interest rates had gone up, and that's typically what you expect from bonds and listed property. But the best place over the longer term has definitely been the equity markets, and over the really long term, 10 to 15 years, the US equity market was really the standout area. If we have a look at the same thing, but just for the South African markets, this slide is showing returns in South African rands, and we can see it was a very strong month again for November. As I mentioned, listed property and South African equities doing really well. The bond market also up almost 5% for the month. And then if we have a look at on the currency side, the all foreign currencies strengthening, although the dollar only marginally by up just over 1%. The other interesting thing to now start looking at is the 5-year numbers are showing that the South African equity market has made up a lot of the returns that it lost out on during the end of the Zuma years. And we can see the 5-year number on the JSE now up over 12% per annum. Our bond market up around 8% over that same period. Maybe the last thing, interestingly, if we look at year to date, that the South African bond market has actually outperformed the South African equity market, and the same thing over the last year. And that's just because our bond rates have got so high, and they've now rallied quite strongly as global interest rates have fallen. So how has this filtered through to our different models? We'll start with our US dollar models. The global strategies shown here in US dollars, we can see all of them outperforming over all periods, 1, 3, 5, and the since inception return is now a 7-year return. And we can see this last year has actually been quite strong for the US dollar models, in US dollar terms, up 8.3, the most aggressive strategy, our growth strategy, and that over the last 7 years has done 6.5%, and that's about 1.4% ahead of its competitors, hence the green shading over the relative return. So same slide, but for our global strategies that are denominated in British sterling. And we can see here over the last 3 months, this is a very new model. It's only just hit its 2-year track record. Since inception, doing very well, having outperformed the peers quite nicely. At least the last 1 year now is a positive return, although just over 1% in the balanced and growth strategies behind peers. But that's just a function of some quite volatile markets that we've seen. We've tended to generate some outperformance as we've seen markets pull back on some of these strategies, but the long-term numbers still outperforming. This slide has a look at our South African focused models, and here you can see some really good outperformance over many periods. The longer models here have been going for well over 10 years. And we can see, if we have particularly a look at the 3-year column, again some strong outperformance of the peer groups, but returns, if we look at the more growth orientated strategies of Core Wealth Balanced, Retirement Growth, Core Wealth Flexible, and our recurring income growth strategies, all of them returns in excess of 12%. Inflation over that period was at 6.1%, so that means that you've had returns here in excess of inflation of between 6 and 8% per year over the last 3 years, and that's a really healthy return in helping clients' portfolios or clients' wealth to be grown at a real rate, in other words, a rate ahead of inflation. So while we're going to look ahead, we're actually also going to try and contextualize that in what has happened over the last while, because there have been some big moves in the market. And this first slide just shows you how the inflation level in the US has moved over the last 3 years. And we can see just in 2020, and prior to that, inflation in the US was really virtually non-existent, less than 2%. And that rose dramatically until June 2022 to over 9%. It's now come back quite strongly and is hovering around the between 3 and 3.2%, which is good to see. The question is it going to get back to those previous levels that the market was used to? This next slide just has a look at when interest rates peak, what effect that has on the economy. And the concern we've mentioned a few times is that we could see the US economy go into a recession, although there's a number of market commentators are feeling that that's less likely, but I don't think the jury's out on that yet, and it is still a possibility. Usually once interest rates peak, you see recession filtering through around 24 months or two years later. So that is still a risk that we think could be on the horizon. This next slide just shows the US economy, how resilient it has been in 2023, and you can see that graph just continued to go up from quarter to quarter in this current year. So still looking at the biggest economy in the world being the US, and if we have a look at this next slide, it just shows how the US consumer was given a whole lot of money by the government during COVID. That went up to over $2.7 trillion that the citizens were sitting on in their savings, and they've been using that money over the last year and a bit, and that's fueled the economy. So they've been spending that money that the government gave them. That number has gone down from 2.7 trillion to 1.1 trillion, but still a lot higher than it was prior to COVID. The next slide just has a look at home ownership and shows that more than 50% of all US mortgages were originated in between 2020 and 2022, those 3 years. And they were at very, very low levels, which means the average homeowner is not having to pay a lot for their house. That means that the average consumer is not affected by the recent rise in interest rates, because they locked in those bond rates in between 2020 and 2022. This slide now shows what the effective interest rate is of the mortgage holders in the US, and the black line really shows you that effective rate, and so it's only somewhere around 3%, not materially higher than what it's been. In fact, it's lower than what it's been for most times in this graph. And until new investors have to start buying houses, that effective rate is not expected to tick up much. One of the phrases that has come out of 2023 is that of immaculate disinflation. And really all that's referring to is that we've seen inflation coming off those highs that I showed you in the first graph of this section without unemployment rising. And that's really something that has been quite remarkable in the US economy at this moment. And so something, if that can continue, it will be we'll see that economy growing again, and it may even avoid the risk of a recession that we spoke about earlier. So where we are now, we are putting up in the slide 3 possible scenarios. There's the green bull case, which is a soft landing. Things just get better and better in the US. They managed to bring down inflation without getting lots of unemployment, and that would be a good scenario for equity markets. And interest rates would continue to be able to be cut. The bear case scenario on the far right in orange is a hard landing, that we suffer some additional shocks in the economy from geopolitical turbulence, which remains an issue globally. Inflation goes up again. There's a global recession, and central banks are unable to cut rates because they've cut them so much already. But the most probable scenario is the one in between the two, and that's really seeing that the interest rates start to slow down the economies, and we see that inflation does come down, but perhaps not as much as everybody wanted to. Some unemployment comes into the system, and we see a bit of a mild recession in the US. I think from an importance point of view, what we have within our portfolios are a mix of managers and asset classes that can react to these different scenarios. So whether it's a hard landing or benign stagflation or a soft landing, managers can move between asset classes to generate the outperformance that we've seen. I guess the one thing that I've seen again this year, and it's been the case for all of time effectively, is that good times come and go, and we have good markets and we have bad markets, we have challenging times, but the point is to find a good strategy that matches your needs and stick to it through time. Had investors pulled out of their investments in September, October, when markets were particularly weak, they would have missed out the strength in November. But the long-term strategy is to stick to what is appropriate for you, and the returns do come, even if there is volatility along the way. We'll be closing our office between Christmas and New Year, as we always do. If there are any severe emergencies, you'll have your advisor's cell phone, I'm sure, and you should be able to get hold of them or at least message them. But for those of you who celebrate Christmas, God bless. I hope it's a really good time for you and your families. And for those who are just taking a break over this time, enjoy it, have some good recreation, come back enthused for the new year, and we look forward to 2024 and continuing to find ways to add value to our clients' portfolios and lives.